What if everything you think you know about money is backwards? What if debt, the very thing we're told to avoid, the thing that ruins households, traps nations, collapses empires, is actually more valuable than cash? That's right, more protected, more powerful, and more profitable. Because behind the everyday world of savings accounts, cash deposits, and government budgets lies a hidden financial logic, one that quietly flips the value of money on its head. This logic is so counterintuitive, so uncomfortable, that most economists avoid saying it out loud. Yet it's the invisible engine that powers global finance, drives political power, fuels banking profits, and shapes the rise and fall of nations. Today we're pulling the curtain back. This is the story of how society discovered that debt is the real money, why it replaced cash as the core asset of the modern world, and why the entire global economy now depends on keeping debt valuable, even if it means sacrificing the value of your savings. This is the hidden money logic that makes debt more valuable than cash. Stage setting, background, history. Teasers to understand why debt became the world's most prized financial asset, we need to go back to a time when money did seem simple.
Metal coin.
Gold-backed currency. Physical cash that represented something real. Back then, debt was dangerous. If you owed money, you were weak. If you held cash, you were safe. But slowly and deliberately, governments, banks, and financial elites discovered a trick. Money becomes more powerful when it isn't real. Paper claims were easier to create than metal. IOUs were easier to multiply than coins. Promissory notes were easier to trade than physical gold. And the people who issued the debt controlled everything. This shift didn't happen overnight. It evolved through crises, wars, banking revolutions, and desperate political decisions. But once the transformation was complete, the global economy couldn't go back. Debt had become the lifeblood of nations and the most important product in the world. And here's the twist. This system only works if debt stays more valuable than cash. If that flips, the entire global financial structure collapses. How did we get here? Let's unfold the story. One cause, one crisis, one consequence at a time. The origins of the Tasmany system begin in the 1600s with the rise of early central banks, the Bank of Amsterdam, the Bank of England. The early European lenders who issued more paper receipts than gold they held. This wasn't greed, it was necessity. Governments needed money to wage war. Kingdoms needed money to build fleets. Merchants needed credit to expand trade. Physical gold was too limited, but promises were infinite. So banks created money not by minting it, but by lending it. Every new loan increased the supply of money. Every government bond issued created a new financial asset. Every debt became someone else's wealth. Suddenly, the world discovered something shocking. Debt is not the opposite of money. Debt is money. It is counted as an asset. It is traded as wealth. It is used as collateral. And the more debt that existed, the more money the system had. This was the first turning point. The world moved from money first to debt first. But this new logic had a consequence no one understood yet. If debt is money, then the entire system depends on making sure debts get paid. And if debt stops being valuable, if trust collapses, everything falls apart. Which brings us to the next chapter. How debt became the core of the global economy. The rise of debt dominance began in the 20th century. After World War I, Europe was buried in government bonds promises that couldn't be paid. After World War II, the United States took control of global finance through the Bretton Woods system. And then came the big moment, 1971. Nixon closed the gold window. Money was no longer tied to anything physical. For the first time in human history, all money became debt. A dollar was no longer a claim on gold. It was a claim on the government's promise. Bonds replaced gold as the base layer of the financial system. Central banks held government debt as their primary reserve asset. Banks used government debt as collateral for their own lending. Cash itself became a liability, a promise issued by central banks. From that moment forward, cash was created when someone borrowed. Economic growth required more borrowing. Financial markets grew by expanding debt. Governments funded programs by issuing debt. Banks made profits by multiplying debt. Debt was no longer inferior. Debt was the foundation. Why? Because debt, unlike cash, pays interest. Debt can be traded. Debt can be used as collateral. Debt is backed by law, taxation, and national power. Cash just sits there. Debt produces cash flow. Cash produces nothing. The entire logic of global finance flipped, and this set up the inevitable breaking point. When debt becomes too valuable, by the 1990s and 2000s, debt had become so central to the economy that governments, banks, and corporations needed it constantly. Household mortgages, corporate bonds, sovereign debt, student loans, derivatives backed by loans. But something strange began happening. The demand for safe debt, especially government debt, began to exceed the supply. This is where the hidden logic fully reveals itself. If debt is the safest asset, then cash is actually the risky asset. Why? Because cash loses value through inflation. Government bonds, especially U.S. bonds, gain value when interest rates fall. Cash is unproductive. Debt generates income. So global investors began hoarding government debt. They treated it like gold. They needed it as collateral for their own lending. They needed it for regulatory requirements. They needed it to manage risk. Debt had become the premium asset. This is where things started breaking, because when debt becomes too valuable, governments must issue more of it. Interest rates must fall to keep the system stable. Central banks must print money to support debt markets. Banks must expand credit to keep the economy running. When debt becomes the most valuable thing, the system becomes addicted. And addiction has consequences. When debt outgrows the real economy, once debt began growing faster than the real economy, the fallout became unavoidable. We saw it in 2008, housing debt collapse. The value of mortgage debt fell. Banks nearly died. 2011 European debt crisis. Countries like Greece, Spain, and Italy couldn't borrow and almost toppled the Eurozone. 2020 liquidity crisis. Global markets froze because there weren't enough U.S. government bonds to use as collateral. Every crisis followed the same pattern. Debt becomes too valuable. People hoard it. Markets freeze. Central banks intervene. Debt creation accelerates again. The system cannot allow debt to lose value. It cannot allow defaults. It cannot allow interest rates to rise too far. So what happens? More debt, cheaper money, lower interest rates, higher asset prices, more borrowing. Repeat. The fallout is clear. Home prices skyrocket because mortgages expand. Stock markets inflate because companies borrow to buy back shares. Wealth inequality surges because assets financed by debt rise faster than wages. Savings accounts lose value because cash is the worst place to store wealth. Debt became the engine, and cash became the casualty. Why every attempt to reset the system fails for decades. Economists and policymakers have tried to fix the system, raise interest rates, cut deficits, reduce government borrowing, encourage saving, limit bank leverage. None of it works. Every attempted fix collapses for one reason. The global financial system functions only if debt keeps expanding. Slow debt growth gives recession. No debt growth gives depression. Falling debt gives collapse. Debt isn't a side effect. It's the operating system. If governments stop issuing it, global collateral dries up. If banks stop creating it, money supply shrinks. If households stop borrowing, consumption crashes. If corporations stop borrowing, investment falls. Debt expansion isn't a glitch. It's the model. And every failed fix proves that the system cannot go backward, only forward. More debt, more leverage, more financial engineering. Which brings us to the world today, where this logic is more extreme than ever. Shocking data and repeating patterns today. The math is staggering. Global debt has surpassed $340 trillion, far exceeding global GDP. The U.S. adds over $1 trillion in new debt every 100 days. 80% of the world's financial assets are debt-based claims. Corporate debt is at record highs. Household debt hits new peaks every year, and yet, markets panic whenever debt issuance slows down. Governments panic when interest rates rise too quickly. Central banks panic when the value of government bonds falls. The pattern repeats. Debt becomes too valuable, gives liquidity freezes, gives central banks intervene, gives debt expands further. This is why central banks cannot allow cash to be more attractive than debt. Imagine a world where cash earned real interest, held stable value, and competed with government debt. Investors would not buy government bonds. Banks could not expand credit. Governments could not finance themselves. The system would collapse in days. So the hidden logic remains in force. Debt must remain more valuable than cash. It must be in demand. It must be protected. And its value must be propped up. Because if people ever stopped believing in the value of debt, the entire economic machine would stop. Final takeaways. So what does all of this mean for you? Let's break it down into 3 clear takeaways. Takeaway 1: cash is no longer wealth. It is a liability. Inflation erodes its value. Interest rates rarely keep up. Holding cash means losing purchasing power. Debt-based assets, government bonds, mortgages, corporate debt now sit at the center of the financial world, whether you like it or not.
Takeaway 2.
Debt is the backbone of global power.
Takeaway Vader.
Governments issue debt to project strength. Banks use debt to create money. Corporations use debt to inflate value. Debt is not the enemy. Debt is the currency of power. Takeaway 3. The system cannot reverse, only adapt. The world cannot go back to gold. It cannot eliminate debt, cannot run on cash alone. The system can only move forward through more debt, more credit, and more financial engineering. This doesn't mean collapse tomorrow, but it does mean instability ahead. The warning: if you ignore this system, you suffer from it. If you understand it, you can navigate it. Because in a world where debt is more valuable than cash, you need to think like the people who built the system, not the people trapped inside it. If this video helped you see the financial world differently, if it made you question, rethink, or reframe how money works, then make sure to hit subscribe, tap like, and turn on notifications. Because this is just the beginning. We're diving deeper into the hidden forces shaping money, power, and global economics. And you'll want to be here when the next layer is revealed. Thanks for watching. Stay curious, stay informed. And I'll see you in the next video.